Hello and welcome to this video on how to brace for a recession. As we all know, a recession is a period of economic downturn where the GDP declines, unemployment rates rise, and there is a general lack of consumer confidence. In this video, we will go into more detail on how to identify the signs that indicate a recession is imminent, and provide examples of previous recessions to help you understand what to expect. We will also discuss steps you can take to prepare yourself and your finances for an economic downturn. Understanding a recession. A recession is a significant decline in economic activity that lasts for at least 6 months. During a recession, the GDP or gross domestic product, which is the total value of goods and services produced within a country, declines. In addition, unemployment rates rise, consumer spending decreases, and businesses may struggle to stay afloat. A recession is a natural part of the economic cycle, and they happen every few years, so it's important to know how to prepare yourself and your finances for one. Key indicators of a recession. There are several key indicators that suggest a recession is imminent. Let's take a closer look at some of them. Stock market declines. One of the most obvious indicators of a recession is a decline in the stock market. This is because investors start to sell their stocks, and the demand for stocks decreases, which leads to a decline in stock prices. In the US, the S&P 500 is a widely followed benchmark for the stock market, and during the 2008 recession, it declined by 56%. Keep an eye on the stock market to identify any significant declines. Increased unemployment rates. During a recession, businesses may struggle to stay afloat, and as a result, they may lay off employees. This leads to an increase in unemployment rates. During the 2008 recession, the unemployment rate in the US rose to 10%, which was the highest it had been in over 25 years. Keep an eye on unemployment rates to identify any significant increases. Decline in consumer spending. During a recession, people tend to be more cautious with their spending. They may cut back on non-essential items and focus on necessities. This leads to a decline in consumer spending. During the 2008 recession, consumer spending declined by 3.1%. Keep an eye on consumer spending to identify any significant declines. Slowdown in business activity. During a recession, businesses may struggle to stay afloat, and as a result, they may slow down their activity. This leads to a slowdown in business activity. During the 2008 recession, the manufacturing sector in the US slowed down, and businesses were not investing as much in new projects. Keep an eye on business activity to identify any significant slowdowns. Examples of previous recessions. To give you a better understanding of what to expect during a recession, let's take a look at some examples of previous recessions. The Great Depression. The Great Depression was a severe economic downturn that lasted from 1929 to 1939. During this time, the GDP declined by 30%, and the unemployment rate rose to 25%. People lost their homes, businesses closed, and the stock market crashed. The 1980s recession. The 1980s recession was a period of economic downturn that lasted from 1981 to 1982. During this time, the GDP declined by 2.7%, and the unemployment rate rose to 10.8%. This recession was caused by the Federal Reserve increasing interest rates to combat inflation. The 2008 recession. The 2008 recession was a period of economic downturn that lasted from 2008 to 2009. During this time, the GDP declined by 4.3%, and the unemployment rate rose to 10%. This recession was caused by a housing market crash and the subprime mortgage crisis. Steps to prepare for a recession. Now that we have a better understanding of what a recession is and what indicators to look out for, let's discuss some steps you can take to prepare yourself and your finances for an economic downturn. Create a budget. One of the best ways to prepare for a recession is to create a budget. This will help you keep track of your spending and identify areas where you can cut back if necessary. Build an emergency fund. An emergency fund is money that you set aside for unexpected expenses. Having an emergency fund can help you stay afloat during a recession if you lose your job or experience other financial hardships. Pay off debt. During a recession, it can be difficult to keep up with debt payments. By paying off your debt now, you'll be in a better position to weather an economic downturn. Diversify your investments. If you have investments, it's important to diversify your portfolio. This means investing in a variety of stocks, bonds, and other assets to spread out your risk. Cut back on non-essential expenses. During a recession, it's important to cut back on non-essential expenses. This might mean canceling subscriptions, eating out less, or taking fewer vacations. Conclusion. In conclusion, a recession is a period of economic downturn that can have a significant impact on individuals, businesses, and the economy as a whole. By understanding the indicators of a recession and taking steps to prepare yourself and your finances, you can minimize the impact of an economic downturn on your life. Keep an eye on the stock market, unemployment rates, consumer spending, and business activity, and take action to protect your finances if necessary. Thank you for watching. If you enjoyed this video, please smash that like button and subscribe to the channel.